episode of Equity Mates. It is that time of week again, Watchlist Wednesday, where we get in an expert. But as always, I'm excited to be here with my equity mate, Ren. How are you going?
I'm very good, Bryce. Look, yeah, we're both excited. We're so excited we couldn't even do introductions. We wanted to start talking about the episode straight away. Watchlist Wednesday, which is fast becoming a staple of this Equity Mates TV show. Definitely our favourite time of the week because we get to hear from some of Australia's best investors and hear about the companies that they're excited about. And, you know, that makes us excited.
Absolutely, absolutely. And it is our absolute pleasure to be welcoming Chairman and Chief Investment Officer of Montgomery Invest, Roger Montgomery, Titan of the Australian investing landscape, to the show. Roger, welcome.
G'day guys, good to be with you.
So, as always, this episode, as Alex said, 3 stocks over the next 15 minutes, unpacking Roger's brain about what is on his watch list. So, Roger, how about we start at the top? Scentre Group, the ticker is SCG. What is it about Scentre that is making it appear on your watch list?
Well, guys, I'll confess that we purchased this stock for the Montgomery Fund and the Montgomery Private Fund back at $2.09, so it's closer to $3 at the moment. Just by way of background, I should say, Scentre Group is the old Westfield shopping malls, the Australian New Zealand shopping malls, not the European and US shopping malls. So Scentre Group is effectively the manager and owner of 42 Westfield shopping malls in Australia. Now, fundamentally what we like about these is they are geographic monopolies. So wherever they exist, that is really a magnet for people wanting to go out and shop. If it's pouring with rain, they want to go somewhere dry. If it's stinking hot outside, they want to go somewhere air conditioned. Scentre Group's Westfield shopping centres or malls really are part of the fabric of, Australia. And back after the sell-off in March last year, so almost a year ago now, or about a year ago, what happened is the stock got down to about $1.50 or thereabouts. And around that level, between $1.50 and $2, what was actually being implied by the share price was an impairment to the company's enterprise value. In other words, its assets, primarily its shopping malls. There was an expectation that there would be an impairment or a write-down of those malls by about 30%. Now, guys, I sat in this very seat during the pandemic giving interviews to the ABC and to whomever else asked, asking me about whether or not the pandemic would change people's shopping behaviour forever. And the expectation was, and there were people out there saying that people won't go to shopping malls ever again. And that's nonsense, because I know that once people are cooped up in their houses for 3 weeks, it's a bit novel. Once they're cooped up in their houses for 3 years, they can't wait to get out. And so we always knew that at some point in the future, what would happen is that people would return to shopping malls. In any event, what we actually knew was that the 30% impairment expectation was actually an overreaction. And in fact, the more likely impairment was going to be about 10 or 15% or thereabouts. Now, we considered increased vacancies, we considered rent holidays, we thought about rent reductions, and we wondered how that would impact cash collections, and in fact it did. And during the crisis, the cash collections fell to just a third, not even a third, about 28% of the pre-pandemic levels. But our channel checks revealed that write-downs, to the extent the market was implying, was unlikely. And so we thought at $1.50 to $2, and our average price ended up being about $2. We thought that was going to be a really good investment. And what's happened since, and we still think it's got legs, by the way, what's happened is that in their fourth quarter calendar year 20 update, customer visits are now about 46 million people a month. So that's roughly where they were in 2019. And over the course of 2020, they had 450 million customer visits. So each customer spends an average of about an hour and a half at a centre. and they spend a total of $22 billion last year. So to put that in perspective, the total amount Australians spend overseas when they're able to travel overseas on leisure is about $42 billion. So half of what all Australians spend going overseas, they spend at Westfield. So we think it's a really high quality asset. It's really an irreplaceable geographic monopoly. Cash collections are now just over $2 billion. A third of that was received in the fourth quarter. So on a quarterly run rate basis, it's getting better. The portfolio is now 98.5% leased or thereabouts, and their fourth quarter gross billings, which is a really important number, was equivalent to about close enough to 100%, call it 99.5% of the rent actually owed. So, on all of the key measures, it's going well, and I still think it's relatively cheap. You have to have a long horizon for this, but eventually, you're going to see things return to normal again.
Yeah, right.
Yeah, it's a fascinating stock, and Bryce here loves his retail stock, so I'm
Yes.
sure that's one that he'll be adding to his watch list. The second stock that you told us about, Roger, was Unity Wireless, ticker code UWL. Now, I'm not that familiar with this stock, so can you tell us what the company does and why it's on your watch list?
Yeah, sure. Look, the company actually said it really well, or there was a couple of sell-side analysts that said this as well, and that is what they're doing is they're basically building the railroad for the internet age. So they're building what are called private fibre networks. So as a new building goes up, so let's say you're a property developer and you're putting in a new building somewhere, you'll bring in a company like Unity Wireless or Unity themselves, and you'll get them to install a private fibre network if you're building a commercial building, for example. So what we know about this business is they effectively operate an infrastructure. It's a private fibre infrastructure business, and it's for wholesale access services. And their footprint is getting bigger, and I'll talk about that in a minute. The other thing that they do is they install fixed wireless antenna, and they basically pick customers off the NBN with an expanding fixed wireless product. So fixed wireless is where you've got the last mile, if you like, or that last connection to the home is a satellite connection, and the rest of the way, the rest of the network is on the broadband network. So we think it's not a systemic threat or systematic threat to the NBN. So the NBN really isn't going to try and shut these guys down. They're not in terms of competition. But they're making good money out of it. Now, what's really exciting about this is the people who are running it. So the CEO, Michael Simmons, and Vaughan Bowen, those two guys, they were colleagues at M2. And Vaughan Bowen was the founder of M2 Telecommunications. Now, M2 was a stock that we'd invested in before, and our small cap team in their business prior, they'd invested in M2. The stock listed at 25 cents, and over the course of the next 10 years, it went to $11.
Wow.
So we think this is deja vu, and with Vaughan and Michael there, we think they're going to repeat that process. So what they're doing is they're building out the brand with acquisitions. They've got superior earnings growth. It's a defensive, reliable infrastructure-like earnings stream that they're building, which we think is really great. And then in the last 12 months, out of all of the new builds, they took 27% market share. They've got a pipeline of over 200,000 premises over the next 5 years. And what's going to happen is that improving visibility in their earnings is going to see their stock re-rate, we think. So we think they're a structural winner. It's a bottom drawer investment. They're operating well. And we think the M&A side of things is heating up as well. So we think because interest rates are really, really low, and this will be true for the next stock we talk about as well, because interest rates are really low, there's international pension funds and super funds that are looking to boost the return to their members. And we price a stable income stock on a 3.5% or 4% yield. These overseas guys, they'll be willing to bid at a 2% yield or 2.5% yield because it's a darn sight better than what their members can get in cash, which is zero. So this is a business that at the moment is still building its future income stream. But once that becomes more visible, this stock will re-rate even more. So we think this is something you want to own for 10 years and you'll do very well. We've bought it and we're just sticking it in the bottom drawer.
Love that. Stick it in the bottom drawer, shut the eyes, and let it tick away.
You
That's
never
what
shut
we're-
your eyes.
I was going to say.
Shut one eye. Shut one eye.
Never shut your eyes and never lock the drawer.
Fine. Keep the drawer open.
Correct.
So, Roger, you mentioned a bit of an infrastructure play, and I guess just based on the name here, I'm purely speculating that the next stock is similar to that. Macquarie Telecoms, the ticker is MAQ. Again, what's this company about? I've never heard of it. I'm assuming Alex never heard of it either. But yeah, what's this all about?
Data centers, guys.
Nice.
So think about, during COVID, of course, all the data centers got a bit of a boost in terms of the thematic, and that's because people were streaming more, people were, downloading your podcast more. They were doing all of those things, and to deliver a really great streaming experience, whether it be music or movies or podcasts or whatever, then the provider of the platform wants to have a version of its platform close to the user. The closer to the user, the lower the latency, and the better the experience. And so that's one thing. But the bigger picture is what data centers offer. So in the past, it was only big companies that really had the money to build their own data center and server racks and their own in-house IT center, if you like. Now, what's happened is data centers have democratized that. So a small company previously couldn't compete with a big company, and now they can because it's cheap. Everything that you need to do can be stored by a third party and can be placed on a third-party servers, and that's what Macquarie Telecom does. So it's no longer the case that you need a heavy upfront investment and massive maintenance costs and an IT team. The scale that you once needed in order to compete is completely gone. And so the technology is available as a service. There's no upfront cost. It's a user pay model, and so small companies, innovative companies can take advantage of this. And so that's what we're seeing. We're seeing a huge take-up. Now, to put this in perspective, the enterprise penetration or penetration of data centers at the enterprise level is still only about 25%. Now, that's where laptops were 18 years ago or where smartphones were 12 years ago. So there's still a long runway of growth to go here. It's a really, really good story. We think it's another structural growth story. It's also defensive and it's an exciting growth story. Now, Macquarie's developing a new data centre in Sydney. It's going to be a meaningful driver of profit growth for years and years. The new data centre will increase the company's capacity in stages. So at the moment, let's say they're at 14 megawatts. They're going to go to 50 megawatts. To put that in perspective, the first stage is 18 megawatts. And that could deliver $40 million of EBITDA on top of the $66 million they generated last financial year. The second stage could deliver another $40 million of EBITDA. So you're going from 66 to 106 to 146. They're big, meaningful jumps in EBITDA. It's a really strong growth story. And then once they've built out that car park and turned it into a really profitable data center, what's going to happen is that they're going to be a boring income generator, right? They're going to have the stock exchange, the ATO as a tenant, the government's going to be there as a tenant, there's going to be various regulators and corporates in there as tenants, and they're just going to throw off cash. And guess who's going to want that? The pension funds. So we think the stock's trading at about $48, $49 at the moment. We reckon it's worth about $70. And then even when it gets to $70, there's potentially another leg up if a foreign investor comes in and decides to pay a lower capitalisation rate for that steady, reliable income stream. So we like it as a long-term income play, and we like it as a growth story as well.
Awesome. Thank you, Roger. So we have run out of time, but just to recap, we had a stock that was part of the reopening, and that was Scentre Group in the shopping malls, and then we had two tech long-term bottom drawer stocks, eyes open though, bottom drawer stocks that have M&A potential, and that is United Wireless, UWL as the ticker, and Macquarie Telecom's MAQ as the ticker. So Roger, always a pleasure. It was good to see you again, and thank you for joining us on Equity Mates.
Pleasure, guys.
Well, that brings us to the end of Equity Mates and our favourite Watchlist Wednesday. But if you would like more information on what we do, head to equitymates.com. Alternatively, follow us on all of the social channels, or you can send us an email at contact@equitymates.com. But Ren, tomorrow we're closing out with some macro.
We are. We started the week talking about bond yields, inflation, and a little bit of a tech sell-off in the US. And we're going to close the week by getting Thomas, the economist, and the host of the highly rated podcast, Comedian V Economist, on to talk us through bond yields, Australian housing, and everything else he's seeing out there in the world of macroeconomics. So not an episode to be missed. Tune in tomorrow, same time, same place. Can't wait to see you then.